We wanted to share with you the 2020 outlook. We would love to have done it in person, but because of the coronavirus restrictions, we couldn't have our evening venue that we normally have. But we wanted to bring to you how these matters that we're discussing financially are so important to you. And so we wanted to make sure that you had this data, even though we've got these restrictions. So the first thing we'll talk about is the equity market and the updates. We'll talk about some planning strategies, and unfortunately we won't have any Q&A as the presentation shows, but we'll try and work with you on any questions you have individually. So feel free to email me any questions after you read or after you see tonight's program. So as a reminder, we're looking at the 5 key areas of financial planning. And these different areas we try and work with every client on. Preservation planning, these are where we look at the needs of a family and how they can be met. Retirement planning is what is the amount of money that we need and the things that we want to do in retirement, not just how much money we have, but what are the things you want to do. The third area is how we control our taxes. This is our biggest expense, health being probably the second biggest. So taxes are very important, and we wish to control those to the best of our ability. Then number 4 is what areas or who will be given your disbursements at your death, so that financial planning is cared for the way you want it to be done. And the 5th thing is how do we want to be invested. So 2019, looking back, was a fantastic year for us. We were able to see equity growth, and we went to an all-time high in December. And as you probably are well aware, the market continued up for the first few months of 2020. But as we remember, markets don't always move up. They don't move in a straight line. It's more like a little roller coaster up the side of a mountain going up. And the little red dots help you to see how the equity markets, even in a fantastic year of 2019, had some low spots that created some challenges. This was always something that we were dealing with because of whatever happened to make the markets go down. You'll note here in the 2-year chart that there's a deeper down right there at the end of 2018. And that creates a great deal of stir, and the market headed right back up after that down spot. It creates opportunities. So this helps us to see how important it is that we look at the long haul. In looking back even further to 2010, we see that the markets were fantastic for the last 10 years. It was a great time. We got through the recession of 2008 and 9, and the markets continued to grow. And then they just started taking off in a very steep way after that downturn. That's the one right in the middle there. This chart shows how the slowdown is being felt around the world in our current period of time. So the GDP growth that is typical, if you'll note, all the graphs are showing that they're down. And that is not just in one part of the world, but it's actually worldwide. So it's a very interesting phenomena when you look at it. And it actually started 2 years ago. So this is something that we are looking to deal with emotionally. In the last quarter of 2019, the IMF actually downgraded the forecast for 2020, citing geopolitical tensions. And this was the biggest one, the trade war that began between the United States and China. That was the biggest geopolitical and trade issue that was out there. The negative trade news caused many problems, and the markets did react to those negatively. In 2019, the Federal Reserve lowered interest rates 3 times, and they were trying to be accommodative as these trade wars continued. And so this is a graph that shows the trade wars and what effect they had on our situation. You see the end of the chart there on the right, the little stair step down. They were trying to lower interest rates to make things a little bit easier. On the next chart, we have the geopolitical things that can go on. There's no certainty to explain all of the dynamics of the market. What we do know is that politics plays a part. We do know that trade wars played a part, but there's also the part of what the banks do and so on. So here's another example. The cost of safety. If you tried to get a CD rate that was reasonable, you could not even get 1%. So this made the opportunities that you have for growth limited. And so that's why the markets were used so highly, or at least it was one of the reasons the markets were used. At the end of 2019 was a game changer, the Secure Act, and we're going to go over that briefly. Most investors think long term. It's nearly impossible to predict, but my little face covers that word. You can prepare, and that's what we are talking about here. So that game changer we'll discuss a little bit later on. The 2020 outlook. If you'll note this graph, you see the downturn that occurred in the market. Everybody knows about this, as the World Health Organization declared that the coronavirus was a pandemic, not an epidemic. That there was a beginning of a reaction to this. And so during the month of February, the market took the longest and quickest downturn in its history, even faster than the Great Depression of the 1920s and early 30s. So they're pointing to this as the reason, and it's probably because people were fearful. If you look at all the things that started occurring in the marketplace, the geopolitical and the economic news, then all of a sudden we begin to see how these things affect us emotionally. This little chart shows history corrections in the past 10 years that were over 10%. So this goes back to 2009, March 2009, and we see these different downturns. The bottom one was 17, then it's 21, then 10, then 10 again, 12, 14, 11, and 20. If you read the decline column from the bottom up. So when we look at the situation that we have in our particular situation of 2020, we see that the downturn in the market was another one of these events. So we're veterans to this. We've seen it. This particular news was responded to, the coronavirus outbreak in the United States was responded to by the Treasury, and they lowered the 10-year Treasury yield, and it's hit a record low. So here's the question that we're interested in. What do you think? Do you think the markets are going to go up, or do you think they'll go down in 2020? Here's predictions from different strategists. You may note the firm. These are well-known firms: Credit Suisse, Goldman Sachs, J.P. Morgan, Wells Fargo, Bank of America, Citigroup, Deutsche, Morgan Stanley, and UBS. And they're all predicting a market up. Right now, the S&P 500 is below 3,000. So all of these men are saying we will see an improvement. So let's draw some conclusions from this particular set of slides. 2019 produced strong results for people that were in the stock market. Volatility can easily reemerge. We've seen that. The Federal Reserve will leave rates alone for now, and the key data for the economic indicators are not unreasonable, and we're still seeing a suggestion of a positive equity return in the year 2020. Now that's despite the downturn that we experienced of over 30%. So, what do we conclude here? Knowledge is power. What do you need to know? So, let's talk about the Secure Act. This is the one that was signed into law at the end of 2019. This particular legislation was designed to alter retirement planning. So, there are some major changes. What were they? This is one: multiple employer sponsored retirement plans. What does that mean? Little companies can team up and set up 401ks, so they are bigger together. Your RMD date was changed from 70 and a half to 72. This is a very big issue for people who do not need the money. The third, anyone who had earned income can contribute to your IRA even after 70 and a half. That's a new rule. So if you're still working, you get to count uh, a deduction on your income tax for your IRA contribution. It doesn't sound like a big deal, but it is. Now, here's a negative. The stretch IRAs that we were used to, in other words, if I inherited an IRA from my parents, I could stretch it for my lifetime. But now they've changed the rule that it has to be taken out within 10 years. This will affect surviving children, but not the surviving spouse. If the children are under the age of majority, it does not affect them. If they're disabled, chronically ill, or if the individual is not more than 10 years younger than that person. So this 10-year rule has exceptions, but the majority of cases will be just like it says at the end. They have to take it out within 10 years with most people. So what are the tax consequences of this? We have to be able to plan the tax bracket that we're in if we receive an inherited retirement plan. We can use charitable-based strategies. QCDs and CRTs are two of those. Qualified charitable deductions, or we can do the CRTs, which are charitable remainder trusts. The qualified charitable deductions are a fabulous tool because you give the money away and it is not a tax event for you. But before we implement any of these, we want to look at your overall wealth transfer situation and give advice. Here's another one. Roth IRA conversions are out there, and we can use these to help us. The first one is the chart on the top says this is a reason not to convert. So if my marginal tax rate as an IRA holder is higher than that of my beneficiary, so there's no need to convert that way because the conversion costs that you absorb as the IRA holder are not offset with the beneficiary if their tax bracket is lower. We can consider a full or a partial conversion if their tax bracket is higher than yours. So if your children are earning a very good income, it may be beneficial to convert to a Roth IRA. Another thing about the Secure Act is that we can really look at the 10-year rule and manage proactively the consequences. So this tax conversion, I should say the Roth conversion to prevent taxes, can be used to spread those distributions and actually make the tax less inhibitive to your beneficiaries. So you note the little picture there, the peanut butter. So I don't know exactly why it's there, but I guess it's a good thing. Every situation needs to be considered individually, and that way we can plan. So when we get together, we want to talk about your particular circumstance and how the new Secure Act affects you. We want to make sure that money is planned to go to the beneficiaries of choice, but we also want to take into consideration their taxes and how we can work together with them. So what is the risk tolerance that we are talking about here? This is an older concept of financial planning. It should be one of the foundation stones. Risk is where we can lose. It's the event that occurs where it's unfortunate. It turns our situation negative. It could be an economic loss, or it could be some estate issue that could happen. The probability of this happening needs to be considered, and then after we do consider it, we want to plan. We don't want to be reactive, we want to be proactive. So, what is your risk tolerance? Are you at the maximum? Are you at the low end of it? We have to take that into consideration. So here's a little quick chart to help you to see how your investments manage risk. Stocks, of course, are the highest potential return, but they're also the highest potential risk. As we go down the pyramid to bonds and to cash, our risk lowers, but so does our return. Right now, cash is not even earning what inflation is. So it is a very interesting situation we're in. Risk tolerance matters, and we want to control that risk tolerance. I like to put it, how do you sleep at night? Do you worry about your money? So that's an easy way. This is talking about how we manage our risk. Here's another slide. Everybody gets afraid when they see this because they go, oh, volatility. We hear that in the news and we go, what does that mean? This is what it means. When we see a market decline, it's going to happen almost every year. A 5% is 3 times a year historically, 10% is once a year, 15 is once every 2, and 20 is every 3.5. So what does that mean? That means that when we move forward, we proceed with caution. We don't just look at what the returns could be, but we also look at the risk. Here's a big one. This is a very big one. Media magnification. Don't look at what the media says, but rather look at your personal needs and your personal circumstances. The media is very loose with its terminology. Market crash, unrecoverable unemployment figures, huge market downturn. All these things are designed to generate revenue from them because bad news sells. But here's the point, it's in red. The media is not your advisor. I am. So we're going to look at all things and put them together. Most of you have seen the 2019 tax forms already. That's what this is. And so instead of us looking at each little piece of the puzzle, we want to put them all together and look at them all. So we plan instead of predicting. What's my tax bracket going to be? What is my risk tolerance? How do I want my money distributed? And how am I investing? Is it really the right way to do it? Here's another thing, overall planning approach. This is a S-curve showing how people respond emotionally to the markets. And that plays a large role in the way some manage money. So when the markets are up, they go, let's buy. And then when they top, they say to themselves, I'll be okay. It's only temporary. It starts to go down a little too much, then it's time to sell. And then when the market starts to go up, they say, well, maybe I need to get back into the market or time to reevaluate. That's the wrong way to do it. You're buying high, selling low. We don't want to do that. So we want to be able to look at our strategy and plan accordingly. For example, review your goals. When do I need my money? What's my time horizon? What's my risk tolerance? How comfortable am I with what I've built? Is it really going to do the job that I want it to? So we need to focus on that personal objective. And the way do we do that? We talk. Remember what's in this box. Are you in control? The answer is yes. We can control it. So here's some of the approaches we can take. We can rebalance your accounts. We can look at all your income sources and look at cash flow requirements. In other words, do a budget. We look at our budget. Are we staying within it? Are we needing extra money to meet our needs? Then we have to look at our tax planning strategies. How do we control our taxes? Do I have enough in an emergency fund so I don't have to take money out and overrun my investment plan? Do I fund my retirement accounts if I'm still working early in the year so they have the longest time to grow profitably? And then reviewing, monitoring your portfolio regularly. Tax planning strategies is another one if you're still working. Maximize your retirement plan contributions. We can put into our retirement plans, if you're over 50, $27,000 in 2020. Another thing we can do if it's not a retirement plan, we can use tax losses or gains and we can harvest them. And this will offset our taxes and bring our capital gains down. We were able to do that in 2018 and 2019. We were able to do it mostly. 2020 should be a piece of cake. So let's look at that very carefully. We also want to look at tax exempt strategies and investments, municipal bonds, annuities, and others. How can we use these? Are they good ideas for me personally? And tax advantage strategies would be some of these other features we talked about, Roth conversions and so on. But we have a few key takeaways. Caution is critical. Vigilance is critical. So focus on your personal goals and objectives, and then call us with your concerns. That's the way you can get advice. I'm a sounding board. I'll give you ideas, and we can take away what needs to be taken away and get rid of all the, what do they call it, background noise or the fluff that the media tends to throw at us. And then review regularly. This is so important. We use eMoney as a program to help you to see how you're working in your particular retirement plan. And we want you to also keep in mind that we use constant communication. You'll get from us newsletters, you'll get from us emailed concepts, you'll get little presentations that we email, and then when you want, we can have one-on-one. I guess one of the areas that we're going to have to use, unless this virus situation clears, is we'll have to do more Zoom meetings. So I'll set up an account, and then if you have the ability to Zoom, when Ev calls you for a review, say, I can Zoom, set it up. We'll also look at the economic events. We'll look at tax rule changes, estate rule changes, and we'll look at the current investment issues that we're facing. There are many, but this is what you can expect from us. We will be there to help you through these very turbulent times. We maintain a non-emotional objective. We avoid emotional-based reactions, and we assist with decisions that are in your best interest. Here's the big one. We're here for you. So thank you for this opportunity we've had to discuss these items. These are reviews. Now, there's a couple of other things we'd like to point out. Help us to help others. Sign up your friends for our complimentary newsletter service. And I'm going to go back to that for just a moment. For those who refer us to a number of people, we have a very special event, provided we can do it this year. We hope we can. So we'd like you to be part of that very special group. Now, we won't have Q&A today because we're on this internet presentation, but feel free to email me your questions or telephone me. We'll be happy to talk to you and share with you the answers to those questions. And if we don't have them today, we'll get them for you, particularly with some of these more complex tax law changes that we've had from the Secure Act. We've also had the CARE Act. That was not in this presentation. The CARE Act was money that was given to taxpayers $1,200 for most. And then business owners could take a payroll protection plan loan from the SBA. So these have some implications, and those events have happened. But if you had some questions, we certainly still have time to talk about those. Feel free to call at any point. I will say this, that if you look at the numbers that we've had in the investment world, in January, the Dow was at 29,000. In March, at the bottom, March 23rd, the Dow was at 18,000. So we lost 11,000 on the Dow. Now the Dow's at 24, almost 25. So that means we've come back 6, which is about halfway back up. So now is the time for us to keep moving forward, determined to see the market bounce back. Remember, the markets look ahead. They don't look back, they look ahead. There is some day-to-day adjustments, but if you notice, even today's news, today is, May 8th, we had a horrible unemployment report, 20.5 million lost jobs in April. The market didn't respond to that. Why? They already knew it. They were looking ahead. What's it going to be like 4 or 5 months from now? The market is saying the economy will be much improved. So we'll see if they're right. I think they will be. We'll keep moving forward. So at this point, I want to thank you for your attention to our presentation, and we look forward to discussing any items that you need to discuss. This is our little legal page, and you're welcome to look at it. But thank you for your attention, and we look forward to our discussions here in the very near future. Bye-bye.